So, you want to own a bank. It sounds almost unfairly profitable. People give you their money, you lend that money to someone else, charge them interest, pay the original customer much less, and keep the difference. No factory, no physical inventory, no need to manufacture millions of products. You simply place yourself between people who have money and people who need it, and collect a percentage every time money moves through your system. But owning a bank does not mean owning a giant vault filled with cash. It means owning a giant network of promises. You promise depositors that their money is safe. You promise borrowers that their loans will remain available. You promise regulators that you understand the risks. And you promise investors that a relatively small amount of shareholder money can safely support a much larger financial institution. When those promises hold, a bank can become extraordinarily profitable. When they break, a bank built over decades can disappear in days. So, let us begin with what a bank actually owns. Imagine you deposit $10,000. To you, that money is an asset. You can see it in your account and expect to spend it whenever you choose. But to the bank, your deposit is a liability. The bank owes you $10,000. Now imagine that the bank gives someone a $300,000 mortgage. That mortgage is an asset because the borrower owes the bank principal and interest for the next 20 or 30 years. This is the basic economics of banking. The bank fills one side of its balance sheet with money it owes, and the other side with money it expects to receive. Your job as the owner is to make sure that the second side earns more than the first side costs. But there is a timing problem. The homeowner may repay the mortgage over 3 decades. The depositor can demand their money tomorrow morning. The bank earns profit by standing between these two completely different timelines. It gives borrowers long-term money while promising depositors short-term access. Most of the time, that works because customers do not all withdraw their savings simultaneously. But most of the time is doing a lot of work in that sentence. Before facing that risk, however, you first need permission to open the bank. You cannot simply create a website, place the word bank above the door, and start collecting deposits. You need regulatory approval, deposit insurance, experience management, a credible business plan, risk policies, anti-fraud systems, cybersecurity infrastructure, and enough starting capital to absorb losses. And deposits are not your capital. Deposits belong to customers. Capital is the owner's money, the financial cushion that gets damaged first when loans fail or investments lose value. Suppose investors provide $25 million to start your bank. That does not mean you have $25 million available to spend on marble floors and expensive offices. Most of that money must remain inside the institution, supporting the much larger balance sheet you plan to build. You still need employees, banking software, lawyers, auditors, compliance teams, customer support, fraud detection, and secure payment systems. Even a digital bank cannot escape these costs. It may remove physical branches, but it replaces them with engineers, servers, cybersecurity teams, and aggressive marketing. The expenses begin immediately. The profits arrive slowly. A loan may generate interest for 10 years. The employee who approved it must be paid this month. Now we reach the primary engine of your bank, the interest spread. Imagine that your bank pays depositors an average of 2% interest. You use that funding to support mortgages earning 6%, business loans earning 8%, and credit card balances earning considerably more. The difference looks like profit, but you do not keep all of it. Some customers default. Some loans are repaid early. Some of the money must remain in low-return liquid assets. And the entire organization must still be operated. Suppose your bank controls $250 million in assets. Only $25 million belongs to its shareholders. Most of the remaining money comes from deposits and other forms of funding. If your loans and investments produce $14 million in annual interest, while deposits and borrowing cost $5 million, the bank has generated $9 million in net interest income. Add another $1 million from card processing, transfers, and account services. Revenue is now approximately $10 million. Then the bills arrive. Perhaps $3.5 million goes to employees. Another $1 million goes to technology and cybersecurity. Compliance, insurance, auditing, and legal work consume another $1 million. Offices, marketing, and customer support take more. Then the bank sets aside money for borrowers who may not repay. After controlling $250 million, your actual annual profit might be only $2 million. That is still an 8% return on the shareholders' original $25 million. And this is why banking can be so attractive. The owners control a very large financial machine using a relatively small amount of their own capital. This is called leverage. Leverage makes small profits look large compared with the owner's investment, but it does exactly the same thing to losses. If your $250 million in assets loses only 2% of its value, the bank loses $5 million. That is just 2% of the total balance sheet, but it is 20% of the shareholders' money. A modest decline in the bank's assets can destroy a large part of its capital, and the bank does not need to make terrible loans for this to happen. Sometimes the problem is how those loans were funded. In the early 2000s, Northern Rock became one of Britain's fastest-growing mortgage lenders. Instead of relying mainly on ordinary household deposits, it increasingly borrowed money from financial markets to fund new mortgages. This allowed the bank to grow much faster. As long as investors were willing to keep lending, the machine worked. Imagine running a restaurant with almost no food stored inside. Every morning, delivery trucks arrive with exactly the ingredients you need. The system is efficient because you do not maintain a large warehouse, but the entire restaurant now depends on those trucks arriving every single morning. Northern Rock had built a highly efficient mortgage business. The trucks were the financial markets. Then, during the financial crisis, those markets began freezing. Institutions became frightened and stopped lending normally to one another. Northern Rock still owned mortgages that could generate payments for decades, but it needed cash immediately to replace the short-term funding that was disappearing. The bank asked the Bank of England for emergency support. When the public discovered this, customers began lining up outside branches. The lines appeared on television. Those images created more fear. More fear created more withdrawals. And the withdrawals created even more alarming images. The bank's assets had not vanished overnight. The problem was that long-term mortgages could not be transformed into immediate cash quickly enough. Northern Rock was eventually taken into public ownership. Its story exposes one of the most important differences in banking. A bank can be solvent on paper, but illiquid in reality. Solvency means your assets may ultimately be worth more than what you owe. Liquidity means you have enough usable money to meet today's withdrawals. A person may own a valuable house and still be unable to pay an urgent bill. They cannot sell one bedroom at midnight to produce cash. Banks face the same problem, except on a scale of billions. This forces every bank owner to make a permanent trade-off. Liquid assets, such as cash and short-term government securities, are safer, but usually earn less. Long-term loans earn more, but cannot easily be converted back into cash. Hold too much liquidity, and profits suffer. Hold too little, and one period of panic can destroy the institution. Growth creates another trap. Once the bank has paid for its systems, management, and compliance, adding more loans appears attractive. Many of the fixed costs already exist. A larger loan portfolio can generate more revenue without doubling every expense, so executives are rewarded for expansion. But the safest borrowers usually receive the lowest interest rates because every bank wants them. To grow faster, the bank may need to enter unfamiliar markets, attract less stable deposits, or lend to riskier customers. The revenue appears immediately. The losses may remain hidden for years. A bank can therefore report record profits while quietly manufacturing its next crisis. So, what are you really buying when you own a bank? Part of it is a toll booth. Money moves through the economy, and you collect small fees. Part of it is an insurance company. You earn income for accepting the possibility that borrowers may fail. Part of it is a leveraged investment portfolio. A small amount of shareholder capital supports a much larger collection of loans. But above everything else, it is a confidence system. Depositors must believe they do not need to withdraw today. Borrowers must believe financing will continue tomorrow. Other banks must believe you can meet your obligations. And regulators must believe the numbers you report reflect reality. As long as those beliefs survive, banking can look like one of the most powerful businesses ever created. You earn interest on loans, fees on payments, and returns on assets financed mostly by money that did not originally belong to you. But the moment confidence disappears, the balance sheet begins moving faster than management can control. So, if you decide to own a bank, understand what you are actually purchasing. Not a vault, not a pile of money. You are buying the responsibility of transforming short-term trust into long-term profit, while hoping that everyone does not ask for their trust back at the same time.